by any means. There's a lot to think about and consider, and many people have actually just focused on dynamic hedging, considered many important real-world effects like transactions costs, including price impact, the information that's conveyed through dynamic hedging, the volatility that's produced via dynamic hedging, and let's say using additional hedging instruments is definitely an important way to think about it. Getting away from Greek letters and the sort of Taylor series approach, but thinking more globally is also an important development. And so let's say even asking if we can find instruments that are so connected, let's say, with the target security that maybe only a static position in those instruments is all that's needed. So there's a lot of interesting extensions, let's say, to the original work, and I think that those are of even more importance nowadays than when they were first proposed, and I look forward to future developments. Okay, thanks a lot. So we have a comment over there. It's Richard, right? Yeah.
Any intuition? What if we hedge every other day? You get
Yeah.
95%.
So we didn't do that, but we do have intuitions. So let's say the theory says that if you double the hedging interval, you'll double the variance. So that's the theory. We haven't done that. The paperwork may differ, and we should look at that. Okay, now another point related to this question that is not well known, that is extremely interesting, is that there's a paper by Lionel Martellini, and it looks at a hybrid of what you're proposing and what we did. So what is that hybrid? It says you sell an option, and you hedge half of it daily, and the other half every second day. Okay? And you could, so you could say, well, on average, I'm hedging 1.5 days, but actually you get a lower variance doing that strategy than you would hedging every 1.5 days. Okay, so it's a very interesting approach, and he also considered, splitting it into thirds and trying those at different frequencies, and he actually found sort of an interior optimal, which I think was 3. And so anyway, it's a very interesting paper, and I suggest looking at it. So it's Lionel Martellini. Another comment?
What if instead of using a sort of calendar interval, you use a market interval?
Yeah.
So that you
Right.
might not be balanced at all if the market hasn't moved.
Right.
But
Right. So yes. So others have definitely considered move-based delta hedging. So there's 2 versions of that at least. So one is you consider moving the underlying. You trade every time the underlying moves by, well, let's say $1. Okay, and the other version of it is that you do delta-based moves. So you trade every time delta moves by, say, 0.05. Okay, and so of the 3 strategies then, which is time-based that we did, move-based in the price of the underlying, which is the second, and delta-based. Of the 3, delta-based empirically performs best, I can tell you, every time it's been looked at. And we need a way to make the comparison fair. So you basically, the way people do that is they pick some process that they feel is reasonable. So I'm just going to use, let's say, standard rank motion just to illustrate the point. And if we're going to do price-based, then we're going to pick the width of the corridor to be such that the expected time to exit the corridor is the time interval I'm using in the time-based one. Okay? And likewise with delta-based, we would pick the width for the delta interval so that the expected time to exit the corridor is the time interval I'm using. Okay, so using that way of comparing, then delta-based comes out best. Yes?
Transaction costs.
Right. So we didn't consider transactions costs. So the question is, and the reason for that actually wasn't laziness this time. It was actually that we were focused on variance reduction. So it's definitely the case that daily delta hedging results in more transactions costs than not delta hedging at all. But the, let's say, our main interest was the reduction of variance. So let's say, I suppose you could take the view that the transactions costs are random, and as a result, you can change the variance of P&L, and maybe that's the point you're making. Now, I seem to recall that you have done recently some work along these lines that incorporated transactions costs. Is that right? Pardon me? Is that right?
I guess the point is, when you say you can do like a perfect hedging, that's in the ideal situation, right? So if you have a lot of transaction costs, people may not do it, and then at the end of the day, the fraction will be less. We include.
Okay, could you repeat your point?
If you don't care about transaction costs, you can reduce the risk even further. Like you can trade like on a
Yeah, so let's say,
minute by minute.
you know,
but that-
the objective, I think the point you're making is that the objective need not be to reduce variance. The objective should actually be to be profitable. Okay, so I agree. And I agree with that completely. And so let's say as a result, you know, this is incomplete. So we're specifically focused on an objective you may not, and I don't necessarily think is all that important, which is variance reduction. And you know, so a more extensive analysis that's focused on maximizing profitability would incorporate transactions costs, definitely. And people have definitely done that. And basically, the result is that, you know, there's a sweet spot, that there's an interior optimal, one should basically, and it depends on how, you know, risk averse you are. But basically, given a certain degree of risk aversion, you can figure out for you what is the optimal hedge frequency. It trades off the negative impact on profitability of transactions costs with the positive impact of variance reduction, you know, due to hedging frequently. Okay. Yes, Steve.
You use the implied volatility in calculating the deltas for this.
Yes.
Which is risk neutral value. And perhaps you would agree that you, in principle, should be using not a risk neutral value, but the empirical value
Of delta?
for delta.
Yeah.
Now, I suppose you expect that delta is relatively small between the two.
Right. Well, we could have, I mean, we can do the empirical delta that is actually used in, by practitioners in some markets, especially when it's thought that the, let's say this other approach has problems. Like if, you know, so like say today your view is that options prices today are crazy. And yet, you know, I have an option position, I want to hold it, and I need to delta hedge it. So if your view is that in the past options prices were fine, one could do a historical regression using those past options prices, past underlyings, and get the delta. And you know, we're not claiming that this approach using implied vol is in any way optimal. It's, you know, it's actually what some practitioners do, and others improve on it, either by doing empirical delta hedging when that's better, or there's yet other alternatives, as I was mentioning, such as taking into account, you know, vega of the option and correlation between the implied vol and the underlying. So this was actually just meant to be, you know, easy to do. And there may even be easier things to do. Like, I know, Steve, that you have a very, very nice way of thinking about the dependence of an option on the price of the underlying, called the, well, we call it the hyperbolic formula. And anyway, I mean, one could also, you know, compute the delta from that formula and see how well it performs. And, you know, I don't know, we haven't done it, but it could perform better. Did you do that in your paper? I see you were.
Well, I was actually thinking about The
Okay.
difference between the kind of stuff that Cliff Green and I did and what you're doing there
Okay.
is we wanted to use an estimate of the true volatility, not the implied volatility, and so then we forecasted that
I see.
using historical volatility, and that was a big source of error right there.
Oh, yeah. So, a big source of error, I see. So I think you're saying, if Learn and I had instead used an estimate of future volatility other than implied, we would likely have not gotten this good a result. Okay. Okay, I could believe that. And we're seeing that as we near expiry, which would be towards the right, the reduction in variance is pretty consistently 95%. So it was no harder to hedge an option with 1 day to maturity than with 30 days is what this seems to be saying, right? Yeah, I agree. I agree it says that. And I also share your suspicion about that. So this is an on average over the 16-year period result. And now, like, one possibility to reconcile our common disbelief is to go back to this graph, the one on the right. And, so it's clear that, let's say, crisis periods make it harder to hedge. And what's also, let's say, I mean, okay, if I just focused on 2000, I'm going to tell this story. In 2000, it's actually the short-dated options, as in 1 month, that are harder to hedge than the longer-dated. And so, I mean, it's worth examining whether the same is true for 1 day versus 30 days, which we could do with our data. So let's say I'm thinking the answer is that it's buried when we do the averaging, that if we focus on crisis periods, that the intuition we both have, the shorter dated options are harder to delta hedge, would come out in just the crisis period data. Okay. Yes, you can.
These are not one-day money options. Most of the time, those options are
Oh.
things that like they're wrong.
Right. So Bjorn makes a good point. They're not at the money, yeah. Yeah. So, right.
After the last day,
They're not, yeah, most of the time they're not, right. Yeah. Yeah, that's true. Thanks, Bjorn. Okay, Leon?
Just following up on Steve's point, I wonder, I mean, you don't have to, like in the PBA market, the coexistence of trader PBO1, model duration, and variable duration, right? In principle, you could use one of 3 possible sources for your delta in doing the same test. I don't know, I mean,
Yeah.
PBAs with, swaps or everything else or whatever. I wonder what you get. I wonder if anything, maybe the traders are in favor of their duration based on superior performance in a test like this of managing the rate risk of a mortgage. I don't know.
Yeah, I agree that's a very natural thing to wish to do. And let's say, I think what we ought to do, I think that, traders are often asked to supply their estimates of things like volatilities for marketing purposes, and if we store that data, we could use it for hedging purposes, which is a slightly different use, but still would be interesting. And I think that's a good suggestion. Getting back to Bjorn's point, I just want to say I think I can be public that we asked Bjorn to teach at Courant the Introduction to Derivative Securities class, so I think that we made a very good choice, given what he said. So, all right, anyway, is there any, yeah, go ahead.
I was wondering if you ran your test against some different underlain with different characteristics, less volatile or more volatile.
Right.
I was wondering if that 95% variance reduction is universal or...
No, I think it's not. So, so I definitely picked a market that let's say where I think the 95% is going to be high. Okay, so you know, if there's lots of, as you switch attention to less liquid options markets, then one could very reasonably expect that fraction to get smaller. So, so for example, like if you have a illiquid options market and you're using the implied vol as the input to the delta, and that implied vol is now in an illiquid options market, a very sort of noisy forecast of future realized volatility, then I could believe that the performance would degrade. Also, you know, SPX being an index, it can only move by so much. Okay, the largest, you know, one-day move is, you know, in 1987, and you know, the individual stocks move by more. You know, so if you let's say it's we all know that you know, jumps are a problem, and you can see it even in this data, and for assets that jump by more, it'll be a bigger problem. So, so I think, you know, on the other hand, let's say currencies typically have a lower volatility than SPX, so, you know, you might actually, for say dollar-euro, expect even better results than here. So, okay. You know, my sense is, like, so that implicitly is relating to another point, but the more volatile is the underlying, I would venture to guess, the worse this delta hedging performs, which is not a theoretical result, but rather more a casual empirical observation. All right, well, I think we've managed to get me through to my allotted time, so I want to thank you for all the questions and comments. And there's no paper yet, but when there is, I'll be sure to thank everybody here, and you know, put it on my website. So I think it's a terrific thing that the IFE puts on this event every year. And I know that there's a few new financial engineers in the audience, and I want to thank you for joining. It's, I think, a great organization. People are very open, I think, and I like that, let's say, the engineering bent to it means that we're all interested in solving problems, sharing solutions, and let's say the engineering is sometimes, financial engineering is sometimes, let's say, castigated by economists who say, well, they're just sort of answering easy how questions and not going into the deep why questions. But I want to make the point that this is my personal philosophy, that you need to answer the how questions before you can answer the why questions. And if you get the how questions wrong, you're not going to get the why questions right. So, and the way things are often done is, when you actually look at it, is often very different from what you might have guessed. So, so understanding how things actually work is, I feel, a necessary precursor to having good models that answer the deep why questions. So that's my personal philosophy, and happy to debate it with anyone afterwards. Thanks. Okay.
It's the favorite part of the day. I'm going to do it really quickly this time. IFE press policy is that all IFE events are off the record, so no attribution of events, and also the speakers here are speaking for themselves, not necessarily